Hi, I'm Kevin Degnan, Global Head of Structured Finance and Covered Bond Ratings at Fitch. Each year, our analysts and relationship managers conduct hundreds of one-on-one investor meetings, answering questions on a range of topics from specific transaction performance to regulatory issues to ways we can enhance our research products. Unfortunately, we can't visit all investors, but we can provide market participants with insight into the types of questions investors are asking us and how our analysts are responding. With that in mind, in this new series of videos, I'll be talking with the heads of our various U.S. structured finance rating groups to find out what hot topics are currently on investors' minds and how Fitch is responding to their inquiries. With me today is Rui Pereira. Rui is a managing director and head of the U.S. RMBS group at Fitch. Welcome, Rui.
Thank you for having me.
Investors are obviously very interested in the state of the private label RMBS market. What are you and your team seeing on that front in terms of volume and performance?
Unfortunately, we're not seeing a whole lot. I think from an issuance standpoint, the recovery in the non-agency mortgage market has been very slow and somewhat disappointing. I think since the market's restart back in 2010, there have been a total of 50 transactions issued, with the vast majority of those placed last year. So the market continues to see or face pretty significant challenges. So things like the continued GSE dominance, rising interest rates, and honestly, the securitization incentives just aren't there right now. However, I think a real positive for the market has been performance. So for the transactions that have been done, the performance has been stellar. And I think that really reflects the very high quality of the collateral that's been securitized, which has resulted in very, very clean payment behavior. I think of the nearly 20,000 loans that have been included in post-crisis securitizations, today we have a single loan that is over 60 days delinquent. So the story is very, very low volume, but very, very clean performance.
That's a remarkable number. How about on the qualified mortgage front? There were a lot of headlines about the qualified mortgage rules. Are we seeing an impact from those rules on issuance, and do you expect to see transactions comprised of non-QM collateral?
Well, to date, I think the impact has been very limited, and we've only seen a handful of non-QM loans included in a very recent securitization. I think for the most part, lenders and aggregators have really focused on adjusting their underwriting guidelines and processes to conform to the new rules. However, we fully expect that non-QM loans will make their way into securitizations going forward. So it's not really a question of when, it's really a question of what type of non-QM loans that we see. Now, non-QM can refer to a pretty wide spectrum of credit, so it can range from IO loans to very high quality borrowers, high net worth borrowers, but it also can refer to loans to lower quality borrowers with, for example, very high DTIs. So it's really a function of what type of production that we see. Our expectation is that initially the non-QM loans included in securitization will be very high quality and consistent with those that we've seen in post-crisis securitizations thus far. But I think over time the credit box is going to expand, and I think we will see lower quality non-QM production securitized. But again, I think it's going to take some time to get there.
One of the more interesting developments in the RMBS market over the last year or two has been the advent of the GSE risk-sharing transactions. You have Fannie Mae's Connecticut Avenue Securities platform, you have Freddie Mac's Stacker platform. What sort of questions are investors asking with regard to those deals, and what are you seeing in terms of the performance of the assets in those transactions?
Well, first off, I think it's important to acknowledge the fact that these transactions have been very well received by the marketplace. And Fitch has been a leader and has participated in analyzing these transactions since the inception of these programs. And I think as a result of that, we've had a very good opportunity to dialogue with investors. And as a result of that, we have fielded a number of questions. And these questions really, they kind of span the gamut. And they range from things like our analysis of the historical GSE default data sets that were released last year. They include discussions about the individual default probability assumptions that we employ for particular transactions, and they also focus on our aggregator review. So our opinion of the underwriting and control environment at both Fannie Mae and Freddie Mac. So they really kind of span the gamut in terms of the questions that we're fielding. With respect to the performance of these deals, it's been very strong out of the gate. And I think the performance is really being driven by two factors. One is the strong credit attributes of the loans and the borrowers. But I think secondarily, and I think also importantly, it reflects the improved underwriting and operating controls at both Fannie Mae and Freddie Mac. I think across the 6 transactions that have been issued under these programs, I think today there's a total of 16 basis points of delinquency, and credit events reported on these transactions have been de minimis. So pretty strong performance to date.
You mentioned earlier the dearth of private label RMBS issuance. And I was wondering, is that lack of issuance on that front leading to more interest from issuers and investors in non-standard, non-traditional type of mortgage transactions, single-family rental, for example?
Absolutely. I think the current very low interest rate environment, as well as investor yield requirements, are really driving a significant interest in non-traditional mortgage transactions. The market's seeing a very strong appetite for non-performing loan transactions, and I think we see increasing demand for both re-performing loan transactions as well as single-family rental securitizations. And I think single-family rental securitizations is a good example to point to, because this is a brand new asset class with very limited operating history. Fitch hasn't really participated in this sector as of yet. But we do think that these securities are rateable, but we haven't seen a transaction where our concerns have been sufficiently mitigated where we're comfortable assigning a AAA rating. However, I think as the market progresses, perhaps some of these concerns will be addressed. I think there are also rumors in the market today about potential multi-borrower, single-family transactions emerging, and I think it'll be interesting to see how those transactions mitigate some of the risks that we've highlighted for single borrower transactions.
You mentioned reperforming mortgage transactions. That's another asset class that's been quite heavily in the headlines recently. Do you expect more volume on that front?
Absolutely. We certainly expect that market to develop as well. I think given the recovery in the housing market and certainly servicers' more active use of loan modifications has resulted of plenty of collateral supply sitting on bank balance sheets. And I think that securitization can provide a good financing alternative for investors seeking exposure to this asset class. However, I think in order for this market to develop with a strong foundation and good liquidity, I think you really need investor confidence. You need confidence in the analysis that's being done, both as it relates to the underlying pools as well as the structure. Unfortunately, I think the early attempts to kickstart this market have really been disappointing, and as a result of that, I think there's a lot more work to do before this market really begins to emerge.
Excellent. Well, let's wrap up by you giving us a bit of your outlook for the remainder of this year for the U.S. RMBS market.
Well, I think given some of the structural challenges still facing the market that I mentioned earlier, I think issuance will remain relatively light. With that said, I think from a credit quality standpoint, we expect transactions to continue to be backed by very high quality loans. And as I mentioned earlier, I think the collateral boxes will expand, and we will see non-QM loans securitized at some point this year. I also think that the success of the risk transfer transactions is going to result in increased issuance. I'm not really sure if you've kept up with the FHFA and some of their pronouncements, but the recent scorecard that they've updated I think encourages further issuance. So I think we're likely to see more transaction activity from those programs. And we're also likely to see some expansion in terms of the assets underlying those transactions. I think recently Fannie Mae has been in the market with a transaction that references a high loan-to-value collateral. And I think future transactions will include that type of collateral and perhaps other reference pools. And then lastly, I think given the current rate environment and investor yield requirements, I think there is a strong interest in non-traditional mortgage assets. So I think we're going to continue to see activity in non-performing, reperforming, and single-family rental securitizations.
Excellent information, Rui. Thank you very much for giving us your perspective and insight into your discussions with investors. If you have additional questions or for more information on the research Rui spoke about, please contact us at the email address on the screen. Thanks for watching.